On behalf of CrossCheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Jay Hatfield. He is the CEO and CIO at InfraCap. Jay, the tariff argument, everybody that gets on this show right now is talking about how tariffs are a headwind. It's a potential challenge to economic growth. It can impact the stock market, the Fed, everything in between. But you have a different approach to this. Can you tell the audience, because it sounds like roses when I hear you talk about it?
Thanks, Todd. Absolutely. So there's a couple of dynamics that people don't understand. The first is the CBO doesn't include tariffs in their deficit forecasts. So we did it for them.
Okay.
We did some modified a couple of our assumptions, and basically we're putting tariffs in. The budget deficit drops from 1.8 trillion this fiscal year, which just ended, to 1.45 trillion. And that's only 4.5% of GDP, which is the critical number because the economy normally grows at 5%, 3 real and 2 nominal. So if the budget deficit is below nominal growth, that means the debt as a percentage of GDP will decline slowly. We're forecasting down to 95% in 10 years. Obviously, it'd be way better if there was fiscal discipline, but we're not likely to get that. And a lower deficit frees up capital for corporations to invest more money. And all of economic growth comes from investment. But some people don't appreciate that, but it's absolutely true. There's studies from the IMF that demonstrate that. So we should get about an extra 0.2% growth from tariffs next year. Not necessarily an immediate term because you do take some consumer spending away, but next year. So more growth, better budget situation, lower interest rates a little bit. And that's bullish for stocks, bullish for our income funds like PFFA and BNDES. So because lower rates benefit them directly. So we think super positive. I just make one distinction, though. We're not in favor of trade wars. So when we talk about tariffs talking 15 to 20%, not 100% on China, we're really like 150% on China. That's bad. That shuts down trade. That creates shortages and can get really big price spikes versus just like a 4 or 5% increase. So I would distinguish between normal kind of sales tax type tariffs versus trade war tariffs.
Okay, so let's back up a little bit, and I want to make sure I got this right. You said that the tariffs, the revenue generated from the tariffs, will equate to a 2% jump in GDP. Did I hear that correctly?
No, 0.2.
A 0.2. Okay.
Yeah, which sounds trivial, but when the power of compounding is pretty major. So there was 0.2, then, and we didn't incorporate that in our forecast, but it probably drive debt to GDP down to like 92, just because 0.2 is nothing in 1 year, but as you start compounding over 10 years, it starts to add up. Obviously, that's 2% more GDP. So, well, and plus the compounding. So sounds small, but it's difficult to get the run rate GDP growth up by 0.2. It's basically savings rate times investment return.
Yeah.
US saves 20%. So we usually grow around 3 is the new sustainable rate after the corporate tax reduction. So to get it to 3.2 would be a big accomplishment because it's just this is the US economy is like a gigantic aircraft carrier, not a Cessna.
Yeah, you're right. So, okay, now let's throw out this scenario then, because what about the inverse? What happens if this trade war ends tomorrow and we go back to the way we were a year ago? I don't know if it can happen, but let's say it does hypothetically. Then that would have a negative impact to GDP, correct?
It would be, and also we'd have much higher deficits. So we're not in favor of that. I mean, it would be great for the stock market if we took trade wars off the table. Like if there was an agreement tomorrow, the market would be up 100 handles. And if Trump just said, "Oh, I was kidding, the whole thing was the taco trade," maybe the market might be up 30, 40 handles, but it's not good long-term economic policy. And really, tariffs are beautiful in the sense that you could never get them passed in Congress. You can't do tax increases, or it's very difficult to ever get fiscal discipline out of Congress.
Mm-hmm.
And so to have the president have the ability to impose these taxes, even though they're unpopular, and lower the deficit is really spectacular. And I actually hope that we keep ratcheting them up over time so that tariffs are more important than corporate taxes, and that we could reduce the corporate tax rate to say 15%. That would spur extra economic growth, but also get the stock market rocketing.
So, in your opinion, and based off of your analysis, is there a percentage, though, that would be a crisscross line, that it would be too much? The tariffs that we impose will be too high, that could actually have diminishing returns on the US economy?
Well, I think we're getting a little bit close to that. So most tariff rates are in 15 to 20, can probably go up to 25. Once you get much above that, then you start to restrict trade, get inefficient trade flows. But most of them have turned out in that 15 to 20% range. But you know, you can extend the items covered, which has been under consideration. You can renegotiate NAFTA and get some tariffs out of that. It doesn't have to be 20, but could be 5 or 10. There's 0 right now.
Mm-hmm.
So little bit of expansion. I wouldn't say like double tariffs to 800 billion, but could get them to grow at 10% a year, and then reduce other taxes.
Okay.
Hopefully corporate taxes, but also could be individual taxes too.
So, in your opinion, do you think as we go into 26, so it's an important midterm election year as well, do you think that the White House just keeps their foot on the gas on this thing, or is there going to be maybe a moment where the president says, okay, maybe enough is enough here. I got to start pulling back?
Well, we have to get the China situation resolved, and which hopefully will, because that's essentially mutually assured destruction, particularly with rare earths involved. So hopefully that gets behind us. And then we don't think that there'll necessarily be any backing off, but just sort of running out of new situations. Most of the there's at least frameworks for agreements with most countries, including the EU. So the news flow should attenuate. That'll be good for the stock market. It'll be marginally good for the midterms. Midterms, though, usually do go to the opposing party. So I think right now the odds are about 70% of the House turning over. So I think there will be a political price to be paid for tariffs. Would have happened anyway, but there's no free lunch. So that's our view, but that's tolerable to have a mixed government because the tax cuts were already implemented, and the deregulation has been implemented. So we don't think it'll impact things much if the Democrats take over the House.
Okay, so let's turn the page here, but talk about another revenue producer, and that's sanctions. The breaking news coming out of Washington yesterday was that the White House will be imposing sanctions on 2 oil producers out of Russia in hopes that it will bring Putin to the table for the negotiation. I'm reading numbers somewhere upwards of $200 billion that's the monetary amount on these sanctions. Any idea, is that money coming back to the US? I mean, where does that cash go?
Well, I think it's money that's being confiscated basically from Russia. So I think a lot of that's going to go feed back to Europe and into the Ukraine and into rebuilding, or just weapons in the short run. So I don't think it's going to be a windfall, but there are a lot of other Trump administration policies that do produce revenue that nobody seems to care about. But 100,000 fee for H-1B visas, they're charging for golden passports, basically. And all these things are a great way to raise revenue. They may not be that material, but the margin, they're all great ways to raise revenue, because you don't discourage investment and work, which most of our taxes do. So everybody seems to focus on the negative. Oh, it's terrible. There's H-1B visa fees, but it's going to be a pretty significant revenue stream from that as well. So I think it's a good practical approach to governing to try to raise revenue particularly from situations where doesn't discourage work or investment.
Okay. Well, that's all sounds great. So you're an income investing type of guy. You're an expert at it, obviously, with InfraCap. What are now with valuations so stretched in the markets right now? You have a very uncertain Fed. I don't know how they're going to come up with a decision next week without any data. However, we do get CPI tomorrow. But anyway, on the ETFs that you're offering, though, can you give the audience an idea of your selection process and which ones actually seem to, or what types of investments seem to do well in these types of uncertain periods?
Well, we have two categories of ETFs: the fixed income ETF, so primarily PFFA and BNDS. One yields 9, the other 8.
Wow,
so that's a great all-weather security because you can be wrong and still be right. So in other words, if you put new money to work and there's a tariff tantrum tomorrow, that might be down a little, but not a lot. And you're still getting paid 8 or 9% on your original investment. So that we like fixed income because it lowers the volatility of your portfolio, increases your income. But we like the higher income securities. So that's preferreds and high yield bonds, PFFA and BNDS. And then if you're worried about the environment, which is reasonable because if we have a mean tweet about China, the market will be down a lot. We do think ICAP's a good place to be because those are small allocation to tech, the more conservative tech companies, but a lot of great companies, good to great companies, but with low volatility. So we have Philip Morris, we have AT&T, Coke. So it's pretty defensive. We do have some higher risk companies like KKR. We love that stock. It's been really hammered because of irrational fears. And by the way, preferreds and bonds did get a little bit cheaper because what we think are irrational fears about credit. So they've come down a little, not a lot. Like I said, they're all weather. But this cockroach theory of credit that because there's fraud at two companies, the whole world's blowing up, we think that's wrong. That came from Jamie Dimon. He's normally very conservative forecaster, let's put it that way. He's normally wrong, conservative and wrong. But you have to do that when you're running a major US regulated bank.
That is true. That he is. He's playing both sides of the fence too on that one with investment banking and regular general banking. But on the ETFs on those though, with the income stream, I mean, do you see any type of now with what the Fed could be doing, not just this session and next week, but also coming up in December? Will that impact your ETFs at all if they continue with their monetary easing period?
Well, absolutely. And actually, SCAP is our small cap income fund. It's not as defensive as ICAP. They tend to small caps do well when the Fed is easing and we're coming out of a cycle. It's not really because they borrow too much money, which some people think, but it's not true. Borrow about the same amount as large cap stocks, but they're just higher risk securities. They are lower credit ratings, smaller, and more volatile. So they do well when there's a Fed easing cycle. And we do think that the decision to ease is pretty straightforward because the housing market is in recession. We have data on our website in case anybody cares, but it's negative year over year investment. Investments drive the cycle. Housing has caused 12 out of 13 world recessions since World War II. The exception being the 2001 dot-com bust, a very mild recession. So the housing sector was clearly headed into a recession. We have a rule, we call it the Hatfield rule, that below 1.1 million home starts would take us into recession. And the 10-year, if the Fed just said at the next meeting, which God help us if they do, oh, we're actually not cutting rates at all and we're at the neutral rate. The 10-year would probably go up 50 to 100 basis points. 30-year mortgage would go up 100 to 150 basis points. And the housing market would go into recession. We would have a recession. So it's imperative that the Fed cuts rates. The job market is weak because the Fed has been too tight for too long and housing and construction are in recession. So even this Fed, which is an incompetent Fed, they're they're Keynesians, they're hyper-focused on labor market. Labor market's weak, so they are going to cut. It's really good for dividend stocks, fixed income like BNDS, PFFA, small caps like SCAP. So you get a little bit more rotation and not just AI trade every day when you have declining rates.
So the long end of the curve though is dropping from the last rate cut. I know it's not enough to thaw the real estate sector, but wouldn't do rates really matter at this point? Because it's really a supply issue, correct?
We don't think so.
Okay.
So there's a bit of a inaccuracy that the Fed, of course, perpetuates because they're not good at their job, but they say, oh, we can't control the 10-year. But if you look historically, the 10-year trades very tightly, about 100 basis points over. If there's a normal yield curve and the Fed is close to neutral, the Fed funds rate. But if they're in an easing cycle, the expected terminal rate, and I have it up on my screen. So right now, the expected terminal rate, or in other words, where they're going to cut to is 294. Well, not surprisingly, the 10-year is right about 100 basis points over that. So there was this notion that they'll cut, but long rates will go up. That was completely false. What happened about 6 months ago is they cut, and then they put a bunch of hawkish statements out, and the terminal rate rose and the 10-year rose. So that's why it's imperative they stay on, not just cut once, but stay on the rate cut path. And we do expect housing to recover. The current 30-year mortgage is about 620. It was as high as 720. That hasn't shown up in the data yet for housing, but we think it will slowly show up. And at a minimum, stabilize the housing sector. So we would always focus on those two elements, the money supply and the Fed funds rate and its impact on housing. That will get you 98% of the way there for predicting both inflation and GDP cycle and also employment.
Okay. So final question for you. It has to be about the Fed. I know we're getting CPI tomorrow. I assume it's coming out at 8:30. I haven't heard of a release time. But other than that, we haven't received jobless claims numbers. We haven't gotten a PCE number. We haven't gotten a non-farm payrolls number. How can the Fed realistically make a decision? And you mentioned it's about labor, but how do they know if the labor market's really weak?
Well, what may end up happening is just get rid of the BLS because they put out really bad CPI data, by the way. We have better ones on our website. But you get actually pretty good private data. There's services that estimate claims that'll probably come out. Well, I mean, that's available. It's not listed on Bloomberg right now, but but ADP puts their numbers out for employment. CPI, there isn't really anybody who calculates that, so it's good that they're putting that out. But the private data is adequate. You get JOLTS as private data to really see what's going on with the economy. So we're not worried about that. And actually, we're kind of happy about it because the employment report's really unreliable. So if they put out something and, well, we have 300,000 jobs, maybe the Fed wouldn't cut. So we actually think in a way we're not in favor of it, but having less data, if it keeps the Fed on a cutting cycle, that's actually better.
So, what the Fed though has always said they're data dependent. I mean, do you think it's irresponsible of them to make a decision without actually having evidence to support their thesis?
Well, only because they don't know what they're doing. If you look at the monetary base, it's negative year-over-year growth. You look at the housing sector, it was headed towards a recession. So you don't need all this short-term data about the housing. Like the
Okay.
employment market, we knew the employment market was going to be weak 3 months before the BLS, because that's just what the data was showing. If you have negative investment in housing construction, it's going to hit the employment market. So if you just use these critical indicators like the money supply, housing, 30-year mortgage rate, you don't need this month-to-month data. So we think it would be irresponsible to not cut. Thankfully, that's the direction they're headed. But you don't need all this moment-to-moment data. Like they're basically, the reason you don't need it is you should be able to do this thing called forecasting. So you really know what's going to happen before it happens. And that's why we had the opposite reaction to the employment data from the Trump administration, because we were like, instead of being like, oh, it's phony and it's showing the economy is weak, we're like, well, finally, the data is reflecting what we were certain was going to happen, which is a weakening employment market because rates are way too high, and rates are impacting not just construction and housing, but also the auto sector. You're seeing some weakness in the auto sector. So these interest rate sensitive sectors, they roll over and you head to a recession. If the Fed doesn't cut, then we're in a recession. So if they could forecast, they wouldn't need all this short-term data.
Okay. Okay. Well, I got to say, we're going to leave it right there because there's a lot going on, obviously, with this Fed meeting, and there's a lot of variables that still need to be figured out. So I know we'll be front and center. I know you will as well. Jay, what is your website? Because I know you mentioned the housing data, you got CPI data, BLS data. Everybody's got to go to this website. What's the URL?
It's infracapfunds.com.
Okay.
And we've added a lot of charts and graphs, so it's easier to digest. And it is highly unique and we think insightful. And so you can use it yourself to come up with your own forecasts. So I would strongly recommend it. And get on our mailing list and we'll send it out to you whenever we develop a new analysis.
Outstanding. Well, I know the show is airing live right now, and we will have an edited version with that graphic at the banner there. InfraCapfunds.com. Definitely want to sign up and take a look at everything that Jay and the team have to say. So, Jay, you always come with everything. You're first class, high quality knowledge. I know the audience loves it, so I appreciate you joining me today, and I can't wait to have you back.
Thanks, Todd. Great questions, and I love being on. Thank you.
Thank you. So on behalf of Jay Hatfield, I am Todd Schoenberger. Thank you once again for joining me on the Money Path. Tomorrow, Margarita Cheng is going to be joining me at 12 noon live for a one-on-one exclusive. Definitely want to hear what she has to say about the market. So until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.